Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome, ladies and gentlemen, to Nirmal Bang. I'm Hiral Dadia. We have with us Mr. Somasundaram, PR Group Managing Director, India World Gold Council, joining in. Welcome to the show, Mr. Somasundaram. My first question coming to you is that gold always has been taken as a safe haven when markets are actually declining. However, last couple of months, the trend has been completely different, where we are seeing both equity as a class and gold as an investment class both have been seeing a good up move. What is your outlook towards this, taking the COVID situation into consideration?
Ah, um, Good question. We have seen both gold and equity markets go up. Generally, they are inversely correlated. Um, but in this particular case, there are lots of equations like that which have been challenged.
Hmm.
So, in the post-COVID scenario, we probably have to get used to it because of the new monetary policies that are being tested ever since the last crisis we had. Uh, you know, the way we see markets behaving, ways we see equations are probably something which we will learn more as we go along. Right now, yes, gold has performed the best this year. Between January and September, it's up 25% and nearly 30% in INR terms.
Hmm.
And if you really go back to 2019, it's actually 60%. I mean, no asset class has given that kind of thing. But you're not going to clearly say because of this, you're going to have another 60% in 2 years.
Hmm.
Now, that's very difficult to say because gold doesn't behave like that. Although there are various estimates, we don't forecast the price. But coming back, in terms of demand, clearly the sharp rise in price since last July, which was nothing to do with COVID. It had more to do with what happens to US dollar and what
Hmm.
happened to the interest rate expectations from the US. So far people are saying, look, there is going to be monetary tightening. And suddenly towards 2019 in the second quarter, it was clear that there is going to be further easing and the
Monetary
rate
easing,
cuts. Now,
correct.
that was a 180-degree shift, which led to the rise in gold prices. That's important to understand. Then came COVID, which has
Hmm.
added to the complexity of the markets around, and therefore gold was found to be the safe haven, clearly. And typically, what we see from the demand figures is this is how the markets work in gold. When prices rise very sharply, consumers tend to stay back and they watch from the sidelines. Is this a blip? Is it sustainable? Is it secular? So, in that process, we did see demand tapering even last year, second half. And then, of course, we got into quarter one, which was okay. It was anemic. And then quarter two was a complete washout, 65 tons, one of the lowest quarters for India and global as well, all the consumer markets. And quarter three, slight improvement over quarter two, but it's still nowhere near what we have seen in the past. It's the third lowest figure in our data series since 1995. So
Hmm.
this is exactly how they behave. But what do we expect in future? I mean, quarter four and beyond. See, gold demand doesn't go away in these markets. People love gold
Hmm.
for various reasons, etc. You will see that the demand comes back. It will in fact spike because there is now a general acceptance that 50,000 rupees, which was a mental block for many people. How can it just went up from 32 to 50,000. Now
Hmm.
that's becoming more acceptable. From 55, when it dropped to 50, we saw quite an improvement in the demand even during the lockdown. So 50,000 now is more acceptable to people, which means this price rise is getting more acceptable in the minds of consumers. So consumers will come back after the lockdown and during this COVID, during this Diwali season. Clearly, you will see an upswing, but it may not be as great as the last year because people are still having lots of other issues to deal with. But you will see eventually it spikes. We have seen this happen in 2009 when soon after the Lehman crisis, demand crashed. It was one of the lowest in the last 20 years, 642 tons. Then came 2010, 11, 12, 13, 1,000 tons, 979 tons, 950 tons. So this is exactly how consumers also behave. So, and you may look at a very sharp spike post COVID.
Right. So, when we say that demand is expected to spike from here on, what's the kind of correlation that we see between demand as well as gold prices? Because usually in any commodity, the trend is that when the demand is low, we usually don't see a price rise. However, that does not seem to be the case here.
Well, you see, you must understand gold is a commodity, all right, but it is not consumed. It is actually a commodity which represents wealth. You hold gold, you don't consume gold. I mean, you change the form from bars to jewelry. It's not consumption. So. Therefore, it is a currency, in a sense. It just tells you that, and you can encash it any time of the day, anywhere in the world, so it has got a certain feature which is not available to other commodities. So to deal with gold as a commodity is one of the it may be a limitation. Now when you look at gold, see, gold is driven by a couple of things. One is economic growth, gold demand. All right, whenever there is a growth, people tend to buy it because that represents prosperity everywhere. Then comes opportunity. What happens to other asset classes around you? So the interest rate is one of the biggest things, actually. So the lower the opportunity cost for holding gold, higher will be the demand for gold. Then there is risk and uncertainty, your perception of the risk and uncertainty. And the fourth one is the momentum, which is what do you really look at in the short run? Is the price going up, coming down? Should I sell, buy? Those trading type of things, short-term momentum things. If you look at all the four, economic growth now is affected. But the other three, risk is high, perceived high, opportunity cost is very low because there is negative interest rate, real interest rate, and momentum is high because the prices has gone up. Therefore, while consumers have stayed back, which is represented by economic growth, you see investors into ETFs and all actually coming in and investing a lot. In fact, year to date, we have seen Europe and US primarily, ETF inflows of 1,000 tons. In fact, ETF hold now 3,880 tons. So when consumers are let's take little cautious, you find investors stepping in. When investors wanted to sell gold in 2013, 14, 15, consumers picked up in a big way. So that is the beauty of gold. So my correlation is, yes, you see demand low, but you see consumer demand low. Investor demand is high.
Right. So, taking this into consideration, I was just reading the new report that the World Gold Council has published for the third quarter of 2020. Clearly, that's indicating that the demand is 19% lower on a year-on-year basis. When do you expect normalcy to return if we are looking at a 19% downtick currently?
Well, this has been a peculiar situation. As we said, there has been price increase. Then we were struck by COVID, and including this quarter particularly, central banks have actually turned net seller in the last decade. They have always been net buyers. They sold a very small amount. Net selling of 12 tons has happened. Okay, although there have been buyers, there have been sellers. The sellers are more this quarter. So a combination of all this has made the demand at 19% lower. But if you see, again, supply is also low. 3% mining has come down. So in our view, I think the consumer markets will come back as soon as this COVID is totally behind us. It's already showing signs of recovery, but as I said, it is not going to be as good as the last year. Once COVID is over, you will see consumer markets coming back. Maybe investors at that time may turn to be a little more lukewarm towards it, but that's when consumers will start becoming more active. So in 2021, hopefully, once the markets are back, the consumer behavior is normalized, we will see consumer demand coming back.
Right. And taking this into consideration right now, what's happening is now earlier the consumption with regards to where jewelry is concerned was always at all-time high, at least when you talk about India. Now we are seeing that the trend has been slightly shifting where gold as an investment bet is increasing in terms of demand versus on the consumption side. What's the trend? Which are the segments where you're seeing investments go up? Is it on the ETF front, or are you seeing physical form in the, say in terms of coins and bars, or even for that matter on the digital side?
Yeah. Um, First of all, other than sovereign gold bond, I want to make it very clear, everything is physical gold. Even ETF is actually physical gold. In a sense, you can even take physical delivery uh, in ETF.
Correct.
People don't do it, but it is only sovereign gold bond, which is paper gold, where there is a promise and a link to price, but it is not, you don't get gold back. So in terms of investment gold versus jewelry, see, Indian purchasers have always looked at jewelry also as an investment. That's why we always go for 22 carat and 18 carat. Never 8 carat and all is not considered gold here. Okay, because we had an investment motive, but an ornamental need, and we matched both our jewelry trade. But coming back, even the classical definition, jewelry versus investment, we have seen this in the past as well. When 2013, when prices actually took a dip, sharp dip, there was a massive spike in investment gold. In fact, that year, bars and coins were 39% of total demand. On an average, we see only 20 to 25% of total demand in bars and coins. That year was 39%. But
Wow.
it again came back to normalcy. 75% jewelry was the norm. I think we will see this play out here as well, because today you get bar and coin at a lower, what I call labor charge. The minting cost, etc. Gold
Correct.
plus, that plus is very small in a bar or a coin. Whereas when you go to a jewelry, that plus will be 12%, 10%, it can be even 20%. Now, when price has already gone up, people want more gold. So, and there are occasions are also very limited now. The weddings have been postponed. They are muted affairs. So you would want gold, but you may not want jewelry immediately. Therefore,
Correct.
it is rightly moved to bars and coins, which is not a surprising thing at all. But will this stay? Will this completely reverse the market structure for India? Unlikely.
Right. And with this, what's your view on the sovereign gold bonds as an investment vehicle for long-term investors?
Well, I always say all forms of investment in gold is important. Gold is gold at the end of the day, whether it sits in a
Correct.
jewelry form or a bar and a coin or whatever, ETF or whatever it is. And it is, and particularly in a country like India where people love gold, you need to give various forms. So even though it is not backed by gold, it is a very good instrument. It gives you 2.5% interest on the original investment which you make, not on the mark to market price. It also gives you a tax exemption on maturity at the gold price. Liquidity is a matter of concern. You can't really go in and sell so readily, because there are no market makers in that thing. Having said that, if you have a 5-year view, I think it's a very good product, because you are actually getting 2.5% interest on your investment, which no other instrument in gold ever offers. So it has a place in the portfolio, but we must understand liquidity is not as good as a physical gold or an ETF.
Right. So with all of this, we have the marriage season, the festive season coming up. By how much do you see demand increasing if you have to compare it to the last quarter?
See, last year, same quarter four, which is always traditionally one of the best quarters for us because of Dhanteras, Diwali, and then wedding season moving in till almost close to end of October. Last year was 194 tons. It was not one of the best quarters, but it's still 194 tons was what was sold last year. Normally, you find around 230, 250 tons in the last quarter. That's how you saw. But last year was not 94. I'm not very sure this quarter you might, if things remain as is now, I have to give that caveat, you will not see that jump. But this quarter, for instance, was 53 tons of jewelry and 33 tons of coin, which is 86 tons. It will certainly be better than that. You have already seen the imports have gone up in quarter three in anticipation of quarter four demand. Okay, so the trade is also very positive. So you will have a growth over 86 tons, but it is unlikely to touch 194 tons. Having said that, the caveat is if there is a sharp drop in price below 50,000, if something else happens, or if there is a vaccine announced and people come out, they may use all the money that they have saved, because there has been no expenditure this year on travel, tourism, going out to hotels or buying anything. All those savings might flow into gold, quite a lot of them. So I would therefore always say, if things remain as they are, price remaining the same, COVID not taking any turn either way, and the US elections not upsetting the entire scenario too badly, if that continues, then you may find it is above 86 tons clearly. I mean, you will see a good rise during Diwali and wedding season, but it will not be anywhere close to 194. But if price falls, that is a very different scenario. We have seen even 250 tons being bought in a quarter. In fact, 200 tons being bought in a month. So I wouldn't want to give any forecast on that.
Right. And overall, with regards to the kind of rally that we've seen on gold, what is the realistic rate according to you? Because, at this juncture, everyone wonders, will gold prices come down and we should wait and then buy? And a lot of times people miss the bus as well. So what is a realistic rate according to you currently?
Well, see, it's very difficult to time any asset. All right. I mean, and our buyers know that the best. That is why they always just kept buying during seasons, calling it auspicious, whatever it is, but just keep accumulating. It doesn't matter. Okay. On a Dhanteras, you buy gold. Don't look at the price. So the question is, what would happen? We don't forecast price, as I told you. But for those who are interested, particularly your clients, there is a tool we have developed called Quorum. You can go into our website, you can go into Quorum, which helps you to put in your own feeds on economic growth, demand, interest rates, etc. And you will get an imputed value of gold. It's called Quorum, being used, and we have already got 4 sets of scenarios built in there, which is a sharp recovery, recession, emerging market meltdown. But you can put your own scenarios there, put your own factors, and we have used the Oxford School of Economics to build these scenarios, but you can put your own and see how gold will behave. This is a tool which we have given for people who ask this question: how will it behave? Now, you can look at it this way, because gold is affected by economic growth, interest rate, demand and supply in the long term. So you could look at it yourself.
Right. So if you have to look at gold inching higher from here on, what factors, according to you, should be looked at that could drive prices higher? And secondly, if we could see some bit of further correction that could be coming in terms of gold, what are the events and factors that you would be considering taking the next 3 to 6 months into consideration?
Yeah. 3 to 6 months, again, as I said, it's a little difficult, but in terms of factors that you got to keep in mind, clearly, the major factor is what is happening to COVID. When are we going to get back to normalcy? That's very important, because that depends on other expenditure. hotels, tourism, foreign travel,
Mm-hmm.
everything. Now everything is on hold actually. So that is one of the key things. The second thing will be obviously the interest rate scenario. Third one is US elections. What happens? Is it going to create uncertainty, or is there going to be more clearer direction where everything is set? The fourth one is what happens to Brexit. Is it a no deal Brexit, or it is going to affect Europe? It will affect our exports. So it's all linked. After all, we are part of a global industry. So these factors have to be kept in mind. Interest rates, how fast the economic growth comes back. Is it V-shaped recovery, U-shaped recovery, W-shaped recovery? These factors do count a lot.
Right. And do you think, the negative sentiment is something which is slowly, steadily moving away? And there is a sense of cautious optimism that is returning from here on?
Yes, I do think so. And see, people generally would like to be optimistic, and particularly in India, we are eternally optimistic. Whatever happens, we just take it in our stride and say things will improve. Okay, so clearly there is a lot of expectation that we have seen the worst. So that you can find out in even normal conversations, social conversations now, digital, of course. But I do think that we will see a lot of optimism setting in, and that will get reflected in consumer behavior also.
Right. So overall, right now, if you see central banks as well, it's an interesting trend that I've seen, which I was just reading from the World Gold Council report itself, where the central banks have been modest net sellers in the third quarter. And I think they've turned net sellers in the third quarter for the first time in 10 years. What is this actually indicating to us?
Well, we have noted it in our report, if I remember correctly, that this is not a trend. This is a particular event around quarter three, and it is also something which should be expected. Small banks might sell, small countries might sell gold, and that's the role gold plays. They were holding gold for a rainy day, and this is a rainy day. Governments have many things to do to manage their economies during COVID. So you will see some banks actually selling. What happened specifically in quarter three? There were two large countries which sold, which was Turkey and Uzbekistan. But there were 6 countries which actually bought more than a ton in this quarter. But what happened? The sales were higher than the total purchases because the purchases were low, unlike the previous years. Now, Turkey, why did it sell? See, Turkish central bank is very active in gold. It has been the biggest buyer so far in this year. 148 tons has been bought by Turkey. So it is not a sale for any reason other than to provide liquidity to the gold market. Turkish bar and coin demand has gone up by 300% in quarter three. So in order to manage liquidity, the central bank must have sold. Uzbekistan, again, the same thing. Their reserves are nearly above 50% gold as part of the reserves. So these are what I would say isolated cases and meant for a specific reason. It is not a part of a story where banks have started, selling gold and moving away from gold. This is not part of that story. This is a very, very, what I would say, these are isolated events for specific reasons which have happened. We expect central banks to continue to be buyers for the rest of the year also. And they may not buy as much as they bought in the last 2 years. Last 2 years, you should know central banks bought the highest amount of gold ever since the withdrawal of gold standard. 660 tons, 668 tons range. That's not going to happen, but central banks will continue to be net buyers.
Right. So that's the trend. I mean, they will continue to remain net buyers, and this is a one-off phenomenon that we have been witnessing. And very lastly, do you think that tactical allocation to gold is something which could be increasing from here on, and there could be a shift that we could see from safe fixed income instruments towards gold?
Um, yes, that could be in terms of investors. You see many of the investors now looking seriously at gold and increasing tactical allocations. Uh, on the other hand, you should also understand that there are a lot of people who have lost incomes or whose incomes have shrunk. So they also need a steady flow of income, which is not provided by gold unless you keep selling gold. So you have to see a mix of factors. You will see on the one hand, people, savers, employed people, probably increasing allocation to gold. You will see another set of people, the self-employed others, who otherwise would have bought gold and but actually not being able to afford it because they need gold. They need whatever gold they are holding. They need it to rehabilitate their business. They need it probably as a capital. They may go for a gold loan. They may not be able to afford to buy gold. So you will find a mix of this. How this plays out in the aggregate, one has to see. But we'll have two segments. Clearly, one segment increasing allocation, another segment actually not being able to afford it.
Right. So that's something which we should be watching out for. And it seems as an investment opportunity as well, a lot of buyers that are coming our way with regards to where gold is concerned. But thank you, Mr. Somasundaram, for joining us on the show. It was a pleasure to speak to you as well. Great insights that we picked up with regards to the gold markets. And this is the perfect time as well because there are a lot of dilemmas between investors, whether we should be buying gold post Diwali, during Diwali, or before Diwali. And I hope you enjoyed the conversation as well. Hope to speak to you soon again. And take care and stay safe.
Thank you very much.